Thanks, Carol. So Thomas has over 20 years experience in macro markets and equity research. Prior to co-founding the independent strategy research boutique FundStrat Global Advisors, he served as chief equity strategist of J.P. Morgan Chase & Company from 2007 through 2014. Prior to that, he was both highly regarded telecommunications equity research analyst and also small cap equity, bankruptcy, and reorg strategist from 2004 to 2010. His clients view his work both as contrarian and highly differentiated, as his approach incorporates extensive studies of historical fundamentals, a reliance on credit and cross-market leading indicators, as well as market-based views driven by positions and sentiments. In his career, focusing on technology and wireless companies, investors viewed his approach as a deeply fundamental and contrarian. He identified major shifts in that sector, premised on the notion that outcomes were more dependent on capital expediency, not on investor perception. Some examples of this, some past examples of this approach include his advocacy of reorg investing during the early 2000s, becoming secularly bullish on equities in 2009, recommending recovery in housing in 2012, and arguing that by 2016, the reset of credit scores would seriously boost demand, which indeed has been the case. Recently, he has brought this focus onto cryptocurrencies and blockchain, and as this innovation area looks to rejuvenate the industrial technology revolution. Thomas has also received numerous awards and recognition during his career. He's been top-ranked by Institutional Investor from 1998 through 2013. He was top-ranked 1, 2, or 3 every single year. He was at J.P. Morgan from 1999 to 2014. He previously served as managing director at Solomon Smith Brothers. Thomas is a CFA charter holder and a fellow member here at CFA New York, and is also a member of the Economic Club. He received his BSc at the Wharton School of University of Pennsylvania with a concentration in finance and accounting. Please join me in welcoming Thomas Lee.
Hi, good evening, and thanks for showing up, especially this late at night. I'm really delighted to be speaking to you because I am a fellow CFA, I have been in good standing, so you don't have to worry about that. But the reason I think that matters is I want to speak to you about Bitcoin through a couple of lenses. You know, one, I'm going to make an assumption that the audience is familiar with Bitcoin and maybe what digital currencies are. So what I want to walk you through is a fundamental case. You know, what are the 3 drivers that are making crypto really today the moment that it should happen? But because of CFA necessity, I want to walk you through some ways to think about valuation. You might think Bitcoin is arbitrarily valued, and I can show you that 2 metrics have explained 94% of the price move since 2013. And then I want to talk to you, then take it to the markets and talk to you a little bit about the Bitcoin sell-off. And we have a report coming out on Thursday. So if any of you are clients of FundStrat, you will be getting on Thursday some really, really deep insights. But I can share you some preliminary thoughts about what I think about this sell-off and whether this is, where it stops and et cetera. And then, of course, I'll make sure I leave some time for questions. So to start, I'm going to just briefly hit on this, but you know, there's a lot of reasons to be positive on blockchain, and I think something that's really important to keep in mind is that digital or blockchain solves a few key issues. You know, that's digital trust. I'll explain to you why trust is so important and it's so central to the valuation of a lot of markets. The importance of immutability. But something that we are finding is that not every Bitcoin, or not every sort of use case needs a decentralized ledger. So decentralization is an important element, but it's not necessarily central to what's happening in the blockchain, and some of the opportunities in tokenization. Now, before walking you through why you need to understand digital currencies, I would like to see how many people in this room are born between 1981 and 2000. Okay, so for everyone who's raised their hands, they are a millennial. And for everybody else, I'm assuming they got to be older, because otherwise you're here with your dad or something, or mom. But I think this is really important because I grew up as an analyst, as an equity research analyst in the 90s. So I was Generation X. And so what I have on this chart is what was happening when each generation was in their 20s. Okay, so when the boomers were in their 20s, which was the 70s, there was a lot of innovations. But I think the two that really people remember is the advent of personal computers, and then, of course, the development of software, so Microsoft and Apple. And what was really critical is that those who were in prior generations didn't understand the importance of these two innovations. In fact, there was too much trust in incumbency, right? Everyone thought mainframes were going to be around forever. And then in my generation, a lot of things happened, but it was really came down to two innovations. One was the commercial adoption of the web, and it was the digitalization of cellular systems, because by turning these cellular systems into digital, you created email and mobile data and text messaging. But when I was an analyst in the 90s, I could not convince any of my clients to buy into these notions. So if anyone was covering this group back then, you understand. My peers, so in my 14 years covering wireless, there were 3 times the entire universe of my peers was fired because there wasn't enough investment banking in wireless. So it's clearly one of those things that not only now, 20 years later, do we have perfect foresight and say, well, yeah, of course Apple happened. Well, Apple couldn't have happened without with everything that happened in the 90s. And of course, now when we think about the life through the lens of millennials, think about these things that don't make sense to people who are older than millennials originally. Facebook and social media, the gig economy. Oops. Sorry, view. Full screen mode, I think. Okay. The gig economy, crowdsourcing, and of course now, blockchain. Now, it's not just our personal lives that have actually evolved over the last 20 years. I think if you think blockchain represents a diversion or a complete divorce from what's traditionally happened in the real world, consider that in the last 20 years, there's been massive, massive change in financial institutions as well. Okay, so I'm just going to read you some things that have come to mind in my 20 years covering equities. Number one, before 1990, companies that had negative earnings never went public. They were considered early stage. You'd have to pay a dividend before you ever went public. Well, in the 90s, that rule broke. Today, there's more private equity companies than publicly traded equities. Would you have ever guessed 20 years ago that the private market is bigger than the public market? I mean, it pretty much ruins, Finance 101. Bonds have a negative interest rate and people are buying them. Central banks did quantitative easing and had negative interest rates. Then let's think about some more things. ETF trading is bigger than single stock. Derivatives are multiples the size of the cash market. So I might just say, if you don't think rules can evolve around understanding capital structures and businesses, we've already witnessed this. The rules have changed many times over the last 30 years. Okay, so let me just start with, I think, the first notion, which is trust. And this is a Facebook survey. In 2016, Facebook surveyed millennials, and the interesting conclusion was 92% of millennials do not trust banks. That is almost a complete opposite of every prior generation. In fact, notice that 8% will trust guidance from a financial institution, and 44% feel banks don't even understand them. Well, let's see how trust is doing nationally. As you can see, this is the Pew Research Center, and the question is, do you trust the U.S. government most of the time? It's the lowest level in 60 years. But trust is a bigger problem outside the US. As this chart shows, the US is basically in the middle. The x-axis is trust. But look at all those countries below that. Eastern Europe, Korea, Latin America, Mexico, Brazil, Greece. These are the countries where blockchain is actually flourishing. So I would almost say that you could inversely correlate trust with the adoption of blockchain. So trust is a huge element, and people just don't trust governments. Now, slide 9, another question that comes up is, you'll hear people say, hey, I don't believe in blockchain because it's nothing. How can you have something from nothing? So I just want to show you, I took FANG, which is huge. In fact, FANG is so big at Fundstrat, we actually track it as the 12th sector in the S&P. We think you have to treat it separately because it's so big. That's 2.8 trillion of enterprise value. How much tangible asset value is in FANG today? It's 9% of that enterprise value. 91% of FANG is intangible. Now, of course, that's brand, and it's the customer base, it's the databases and customer knowledge, but basically it's all trust, right? It's the trust that you can have future value. So most valuation of equities today is based on trust. In fact, 77% of the S&P's enterprise value is intangible. So again, if you have a problem with something from nothing, then you need to derate equities by 90%. So there's a few use cases for crypto. Now, again, I don't want to spend too much time because there's going to be a panel. But I want to really spend some time talking about the bookends here. That store of value, I think, is a really great use case for cryptocurrencies. And the second is security tokens. So what is a digital store of value, and what kind of market does it address? What I've done here is I've listed different ways wealthy people try to store value. Gold is, as you all know, is a store of value. It's a $9 trillion market, but it's actually been an okay store of value. It's essentially compounded at 5% over the last 20 years. Collectible art is actually an even bigger market for store of value. And actually more is allocated to art than gold in most high net worth families. But art is a $17 trillion market. Real estate's $228 trillion, and it's CAGR'd at 5%. Government bonds, remember, negative interest rate bonds by definition have to be a store of value, because who else would buy bonds to pay the issuer? That's a $20 trillion market. And of course, there's other collectibles, which is estimated to be $5 trillion. So today, store of value is a $280 trillion market. Bitcoin is $200 billion, which means it's valued at less than 0.1% of the digital store of value. And the question is there a demographic reason this could change? And I will show you why you can see this happening a mile away. I think Bitcoin is going to become a store of value. So I'll skip this slide, but just want to show on slide 13 that for the last since 1875, this is the price appreciation of art using the Moses price index, which Sotheby's acquired. Art's essentially been a terrible store of value because it's CAGR'd at 3%. That's gross. Storage costs essentially would eat away that return. Art has essentially not appreciated after inflation. So let's talk about the other bookend, which was tokenization of businesses, and that's another use case for crypto. And what I've done here is just made a little timeline that tokenization actually started in the 1960s, because in 1969, the first time shares were offered by a Hawaiian real estate company. And then in 1970, we had mortgage securitization. Again, these were fractionalization. And then in 72, frequent flyer miles were introduced, and then net jets. But you can see then in the last few years, we've seen some innovation in tokenization of innovations, Airbnb, Uber, Kickstarter, and now we're starting to see the first assets being tokenized. And to give you a sense for why this makes sense, and I've heard this really talked about before, I think if Facebook was to go public today, it would probably be an ICO, because Facebook is a network. They don't charge their customers to use the Facebook service, but you're giving them all your private data. And that sharing of your digital information has created a vast amount of wealth for the equity holders of Facebook. So it's inequitable, right? That the guys who actually built the network for Facebook got no reward, but the guys who put in the seed money, just tiny amounts of seed money, made all the money. So the idea is that a token today would be a way to reward user engagement, but also allow the capital structure to benefit. So I think tokens really bridge that idea of customer loyalty with capital structure. And again, it's not that different than frequent flyer miles that could be monetized. And another example I would just throw out to you is that I think as we start to think about blockchain and its scaling, that companies like Amazon would be issuing tokens, because it's a way to reward customers and you let them create network value. But it allows the capital structure to benefit if Amazon is got a money supply and issuing these tokens. So again, securitization and security tokens, I think, are really going to be one of the other ways you start to see use cases grow. So let me skip to page 20, because I'm a little concerned about time. And I want to talk to you about the millennials and why this is important. So again, I started to talk to you about trust and how trust outside the U.S. is a huge deal. And I spent some time talking to you about store of value and why that's a huge market. But let me explain to you why I think millennials are the third piece of what's happening. So this is 5 generations of Americans, starting with the greatest generation. They're the people that fought World War II. And then the silent generation, which was really kids born in the Great Depression and saw their parents suffering the Great Depression. Then the boomers, who were the kids of the silent generation. Gen X, which was a small generation that followed the boomers. And then now the millennials, which are the children of Gen X. As you can see, millennials are the single largest population cohort ever in history. It's 96 million people. It's larger than the boomers. So it's not the largest percentage population ever, but it's the largest number of people. And I think the number is actually more important than the percentage. So what's happening with the millennials? Well, this is something that we use in our strategy work, but I think it's relevant today. The average millennial today is 26 and a half years old, which means they're just entering their home purchasing age on average, and they're the earliest ones, or the oldest, are beginning to enter their prime income years. Now, as you look to the left, you can see that millennials, in fact, had a huge impact on alcohol consumption when they turned 21, right? It's a move away from beer. And they've already had an impact on the auto market, but we're going to start to see them have huge impacts on investment decisions and long-term purchases. Okay, and again, I just want to remind you, 92% of millennials don't trust banks. Okay, well, on slide 23, I'm showing you these millennials are now just starting to become into their 30s, and so they're making enough money to actually start saving and paying off student loans. And what happened when generations hit that age, 25 to 45? Well, on slide 24, I'm showing you that housing starts since 1960 have almost been entirely explained by each generation turning age 25 to 45. So as you can see, housing cycle peaks always coincide with the peak of that specific generation cohort being age 25 to 45. And again, I want to emphasize the millennials are now just entering prime income age here. So what happened when the silent generation hit their prime income years? As you can see, that was starting in the 1970s. These were the children of the Great Depression. So when the dollar went off the gold standard, the silent generation bought gold and caused a massive, massive surge in gold prices. But as you can see, subsequent generations haven't bought gold, although this gold is now being transferred via estates to other generations. And we don't think subsequent generations are going to hold gold. The boomers entered the prime income years starting in 1982. Well, what happened from 82, and that cohort peaked in 99? What happened in those years? The S&P exploded. The biggest bull market in history could easily have been explained by just boomers hitting prime income age. Now, Generation X, which is my generation, wasn't big enough to actually drive the S&P, and you can see that secular bear market in that middle there. But millennials are now prime income years, and they're actually enthusiastic about stocks. So we do think this is bullish for equities, especially growth stocks. Gen X, which was my generation, helped drive a boom in hedge funds. And as you can see, that hedge fund boom essentially is maturing with the Generation X cohort. And as you know, millennials are more interested in ETFs and passive products. So what does this mean for Bitcoin? Well, take a look at this chart. I've overlaid Bitcoin's price to millennials. And as you can see, that hook up in 2016 actually did coincide with the first millennials entering prime income years. So I think that at the end of the day, the easiest explanation for why crypto is going to turbocharge the next 10, 20 years is that millennials are comfortable with digital businesses, and trust is important. And I think a decentralized digital currency is a great way to express trust. And if you sort of follow this chart on a log basis, Bitcoin could be a $10 million token before millennials start to retire. And they're all going to retire because they can buy planets with all that money. Okay. So now you might wonder, but remember, there's $280 trillion of store value that some of these aren't great stores of value. I mean, I know people like to buy art, but it's historically not a great store of value. So if you turn to slide 30, let's talk a little bit more short term. And there's George Gilder, who was a technologist in the 2000s, talked about this idea of networks are square the number of users. And MIT professor Metcalf essentially proved that out, that network value explains social media companies and commerce companies. And we tried to apply that concept to Bitcoin. And we said, look, if we took the number of unique addresses as a proxy for users and transaction activity per account, that two-variable regression explained 93% of the move in Bitcoin since 2013. So Bitcoin isn't a bubble. It's just risen because more people are creating wallets and using it. And that's why Bitcoin's going up. And so we just do some projections here at 31 that if you look at unique addresses, it almost tripled from August to December. But if it goes up another 50%, that's our projection. And if value activity per wallet rises another 10%, that gets you to, I'm sorry, it's not in here, roughly $18,000 by the middle of the year. So I think Bitcoin from today is roughly a double. Now slide 33 is trying to put some context about the recent sell-off in Bitcoin, because Bitcoin is down almost 43% since the December highs, and I think if this was an equity, people would be downgrading Bitcoin here, already down 40%. But what I've done is I've actually plotted Bitcoin's price since 2016 to now, and I've plotted the rallies and the sell-offs. Okay, and what's interesting is since 2016, Bitcoin's had 6 declines of more than 25%. And they've been followed by subsequent rallies. But let's put some of these in perspective. So that's on page 34. That when you look at the Bitcoin declines, they average 24 days. That's that number here, 24 days. And most people think of declines as percent from the highs. At JP Morgan, I published a study on bear markets, which essentially we argued that if you look at the last 100 years, bear markets are not declines from a peak. It's a retracement of the prior advance. I mean, it's a logical concept. So what we did was highlight on the right what decline or how much of the prior advance was given up in each of the declines. And you can see that's actually a pretty narrow set of numbers. It's somewhere between 60 to 70%. In other words, every Bitcoin decline has been essentially a 60 to 7% retracement of the prior advance. Well, if we were to say, what does that imply for Bitcoin's price today? That implies that the Bitcoin low will be roughly 9,000. And we're at 10,000 now. So I think we're very close to a bottom. But then the average rally is a 150% move over the next 3 months from that level. So again, if we were to think about that today, that implies Bitcoin would be close to $25,000 by the spring. So I think you'd want to be buying this pullback all day. But on slide 35, I'll just touch on this briefly. We also, at our firm, we actually track all the other tokens. So we have our own proprietary price indices that are tracking the large coins, mid-cap coins, and the small coins. And I think what's really interesting is the gray boxes. The gray boxes represent the small cap tokens, okay? These are the highest risk tokens. I mean, so this is the stuff that if a PM says, listen, I got 3 days to make my performance for the quarter, what do I need to buy? So they'd be buying these gray tokens. But what's interesting is that every Bitcoin sell-off, okay, which is the red ones, has seen the gray boxes near the top. So when you look at this quilt, whenever Bitcoin sells off, small cap tokens tend to outperform. It's showing you that, in general, when Bitcoin's declining, it's not money leaving the blockchain, it's people deciding they found a shinier toy. But here's what's really interesting. When you look at the performance, historically, whenever Bitcoin sells off, everything goes down. But since December, okay, so Bitcoin peaked on December 18th, the average small cap token has doubled in price. So Bitcoin's down 50% and the average small cap token's up 100. The average mid cap token is up 66% and the average large cap token is flat. So this sell-off is unlike anything we've ever seen. People aren't selling Bitcoin. They have essentially used Bitcoin to buy ICOs. So in other words, this, I think, is setting up for a huge rally in the next couple of months. So, and then just a couple more slides, because again, this is a CFA presentation. I want to give you some portfolio ways to think of this. So I'm thinking portfolio strategy. The first is on 37. This is correlation. So the top, just look at the top chart because I labeled that correctly. This is Bitcoin's correlation to 4 different asset classes. And as you can see, its correlation to the S&P is only 12%. So even as Bitcoin has actually grown in popularity, it's still essentially uncorrelated to the S&P. And its correlation to bonds is essentially 0, and to hedge funds it's 0, and it's actually negatively correlated to gold. And again, I think it's proof that it's actually capturing share from gold. And on 39, then we just take a hypothetical illustration. We say, let's say that you took a traditional 60-40 equity portfolio, and that's the first row. Over the last 3 years, you'd have had a compound annualized return of 6.5%, with annualized vol of 7, and your max drawdown of 8%. Okay, so that's your traditional blend. But let's say that you added 2% of that, of your portfolio funded out of equity, into Bitcoin. Your annualized return would rise 250 basis points. Your annualized vol is actually lower, and your max drawdown actually fell. And the point I'm making is, even if you don't believe in crypto, because of its low correlation to other asset classes, it really shouldn't matter what you believe. This is liquid enough for you to use this to diversify your portfolio. And I got some other slides, but that's really the gist of it. So, the bottom line is, we think Bitcoin is establishing a new way to look at capital structure and businesses. And I think as CFAs, you have to really embrace the idea that valuation models have evolved. I mean, even if your professor says, oh, cash flow is king, how do you explain IPOs of negative cash flow businesses, right? And if you think that bonds should always have positive rates, how do we explain negative interest rates? And the fact that there's $20 trillion worth of it, and 80% of bonds in Germany have a negative rate. So it's important to really be open-minded. Again, for those who are older than millennials, just try to think like your college-age student. So, and with that, I'll open it to Q&A. So you're sorry. Which period are you referring to? Oh, yeah. That was now again. That was looking at that. That's a 15-day period. I don't remember the exact sequence of events, but you have to remember in 2017, a lot of the reasons for the sell-offs had to do with Chinese government restrictions, either around mining or trading, and so that was very likely one of those windows. And again, part of the coincident factors behind this recent sell-off has been potential restrictions on trading in some of these Asian countries.
Hi. How do you think that the this new liquid asset class that's being used to fund technology projects is going to impact the kind of future of structures for both hedge funds and venture capital coming together?
Yeah. So you're asking kind of an industry question and a philosophical question. ICOs and issuance through tokens is obviously transforming the nature of early stage businesses, okay? And what it's principally doing is, one, it is essentially democratizing capital raising, because you no longer, I don't know if you guys are familiar with venture capital, but the process is essentially the equivalent of someone trying to pitch a movie, but they only have 30 seconds before the director rolls his eyes. And there's a lot of essentially conglomerate-like activity within venture, right? So that the best projects tend to funnel to the largest firms. So that's raised essentially the cost of equity, right, for an early stage business. So I think one of the principal outcomes of this is that it's lowering the cost of equity to be an early stage company, because you don't incur dilution and you technically don't lose a lot of control. But as you know, the problem is whenever you reduce the cost of equity, it leads to more capital formation. So that's the negative effect of this. I mean, at the end of the day, what's more damaging? The fact that in Europe, a double B issuer, okay, so you guys know in Europe, if you're double B, you're somewhat decent junk, but when I was a wireless analyst, double B was, the really company that was losing money, had like a 30% chance of going bankrupt. They're borrowing 5-year money at 1.6%, which is cheaper than the US government. So the question you have to ask is, I think capital formation risk is much greater outside of early stage right now, because the cost of capital has plunged everywhere. So, but yes, I think ICOs, I mean, a lot of money is being raised, and I think it's risky, but the returns have been good.
Are there companies that you would highlight in terms of the blockchain technology that you could capitalize on, or that you would think about, or a strategy you're managing?
Yeah.
So you have IBM, Microsoft.
So the question is, are there companies that we'd like, or even tokens we'd be interested? We spent a lot of time with the community, and if any of you guys have actually invested any time trying to get involved with it, you'll realize this is actually look, even though there's a lot of people getting wealthy, most of the people who are doing a lot of the core work in this space really care about the need to create trustless systems. I think there's a real belief in that community that they want to change essentially the idea that centralized control belongs to a handful of banks and a handful of big companies. But from our perspective as research providers, we don't think it's suitable for us to be trying to recommend early stage or venture stage or businesses that are 2 years old and dependent on a couple of founders. So most of our work and recommendations are only going to focus on the equivalent of what we consider to be large blue chip ideas. So right now we're recommending Bitcoin, but don't think that that's going to be the limit of what we write about in the space. It's just that there's a lot of great things, and if you want to buy things, I think you should be willing to take risks, but we would do a disservice to people to talk about them.
Hi, I'm not sure if my question is going to be similar to what you were just talking about, but I'm curious, how do you define blockchain equities in this chart that we're looking at right now? And what would be a good way of investing in a basket of blockchain equities? Thank you.
Yeah, that's a good question. I think this is based on a list of 37 global blockchain companies where the majority of their equity value can be attributed to blockchain or fintech-related efforts. So, it includes SBI in Japan, and it includes Overstock here, and some of the mining entities there, and some of the exchange providers in Korea, Bitcoin exchange, companies that own stakes. So, I think I think blockchain equities is a good thematic play if you're strictly only able to buy equities. But it's not the best way to actually leverage blockchain itself. And in fact, if you wanted to find a security that you could hone in an equity portfolio that has exposure to crypto, I'd probably recommend the products by Grayscale. Right now, you can purchase Bitcoin, the Bitcoin Investment Trust, which is GBTC. And I believe they've announced one for Ethereum Classic. And you can buy it two ways. If you're a qualified investor, you can actually buy it new issue from Grayscale, and you don't pay a premium. One of the criticisms of these instruments is that they trade a premium to NAV, but you can buy them new issue from Grayscale directly.
So actually, I have a question from the online community. Have other cryptocurrencies also followed the network effect and trading account formula?
Yeah. So the answer to that is yes. Remember, the blockchain is essentially public for most of the tokens. There's a few that are private. So you can actually, using publicly available sources, and there's many websites, you can actually recreate a lot of the work we did. I know Ethereum has a lot of the data. Ethereum Classic, it's somewhat out there, but I'm going to say that when people look at tokens outside of Bitcoin, I found that there's really two ways people do it. One is they think of a use case, and then they define it as the total addressable market, and then they might do something like the equivalent of, hey, what kind of share can Bitcoin or this token get of that addressable market? I think that's not a bad way to do it, and I think at least it lends the contours of fundamental work. Some people look at a transaction value to market cap ratio, essentially as a PE. But I might just propose a third way to look at crypto in a simpler way. I think you should just use Bitcoin as the benchmark, and then measure everyone's market cap against Bitcoin. And if you think something is worth twice Bitcoin, then just double the market cap. Because I think Bitcoin is so widely held, it's probably fairly efficiently valued. And therefore, if you want to know what Ethereum's worth, you can express it as, well, I think Ethereum's X as good as Bitcoin, and therefore the market cap should be X.
When you consider the price expectation of Bitcoin, do you also consider the Bitcoin technology itself? In other words, the protocol and whether it'll be around in 3 months, 6 months, 9 months?
I mean, it's a good question. Something to keep in mind is, there's a lot of views within the development community, how people view Bitcoin, because it is a slower moving network, right? It's slower, but because of the proof of work, it's quite secure. And I think when we look back 10 years, I think the security of Bitcoin is actually really much more important than how the code works. Because if the network is secure in the Bitcoin blockchain, it's fairly simple, then it ensures like the scarcity and the inability for anyone to create fraudulent. So it's really protected from attack. And since its inception, the Bitcoin network has not actually been hacked. I mean, there's been denial of service attacks, and there's been mining, miniature mining coups, but nothing that has actually ever hurt the security of the Bitcoin network.
Regarding your chart on page 33, where you show that's the one you have there. You are doing it for the last 20 months, whereas Bitcoin has been there for 50 months. If you look at the chart for the entire 50 months, it will show a different pattern.
Sorry, could you repeat the question?
You've done your chart is for about 20 months.
Yes.
Whereas the Bitcoin has been trading for about 50 months.
Yes.
Any reason why you cut it over 20, and how does it look different if you do go to 50?
Oh,
because in 50, go ahead.
It doesn't make a difference. One thing to keep in mind, and I think I mentioned this here, like a year in Bitcoin is like 10 years in the stock market, right? I mean, this is like dog years. I mean, I'd be like eating Gerbers if we go back further, but you could do the same thing. I mean, there's $200, then fell to about. So it had a rise of 5,000%. Not the wiggles, but the big wave. Yep.
5,000%. Then it fell 80. Then it fell 93%. With wiggles within that. Then it rose another 5,000%, and then it fell another 85% to go to 200. And this chart is from 200 onwards, part of that. So actually, there are bigger waves which show a different picture.
Got it.
All right, thank you. Actually, I have a question online from the online community, if you could. Could you discuss the regulatory landscape for crypto trading globally in the near future? Do you think the global coordinated regulatory framework is likely soon, and how would this unfold?
Got it.
Thank you.
I'm going to pass on those questions because I happen to know the panel is going to address those. And I already know what they're going to say, so I don't want to steal their thunder,
Hello. Hi, Thomas. I'm actually based in Singapore, and I noticed here on the NYSE and NASDAQ, there's a boom in SPACs, including fintech SPACs. Do you think SPACs will ever take off in the cryptocurrency market? Because if you look at DAO, they got hacked for $50 million, but management still got to keep their 15% interest, right? But the good thing about a SPAC is you actually have to earn your 20% interest. Thank you.
Yeah, it's thank you for the question. Again, it's probably not something I'm well equipped to answer because it's not part of our research process, to think about how these newer, smaller entities are going to essentially fund their business models. But I would say it's already happening because several mining and software companies have actually essentially done something similar to that. I think more of it's happening in Canada. But again, if you look at the analogy for our traditional work for our clients, we tend to focus on the S&P 500, not the Russell 2000, and not the microcap. So a lot of those things, and they're very important developments, they're not part of the research work we would do.
Thomas, thank you for the talk. I have a question on what do you think is the best investment approach in the blockchain technology? You touched a little bit, but how do one select coins? Should they just invest in Bitcoins, or should they invest in a diversified basket of other coins?
Well, I think if someone is, it depends on their stage. I think if someone's new to crypto, I would strongly recommend they just stick with the largest tokens, because you need to really get adjusted to the volatility. I mean, crypto volatility is not that different than gold volatility in the 70s, but gold was exponentially more volatile for almost the first 10 years. It was the dollar went off the gold standard. And so I think there's a lot of volatility. I mean, in some ways, Bitcoin falling from 20 to 10, I know it's painful for a lot of folks, but I think most probably don't even, they think it's 1 month of price change, In fact, that's the case. Bitcoin's basically back to where it was in November. But I think if someone's actually a lot more comfortable, look, I think that you can generate, this is a space where traditional research tools aren't out there, and I think a lot of the information is not that efficient. So I think if you do spend the time, I think it makes sense to look at some of the altcoins. And I think there are some really cool projects. But again, we don't want to be recommending any of these because it's just not appropriate for what we do. But, I can tell you our clients really are interested in a lot of those smaller ones. And, we try to stay up to speed on some of the more important projects. But again, we're not going to write about those.
Hey, Thomas. Thank you. I guess 2 quick questions. So as far as the trust factor and the showing the millennial distrust in the banks, and you just spoke about the security of the Bitcoin network. What would you say, is that at risk at all with the advent of quantum computing?
Yeah, it's, I think that's actually a big problem with all security protocols is quantum computing, right? Because essentially solving encryption, is key to digital currencies. I'm going to punt that, though, to Nolan, because I know Nolan is an expert on encryption, and I know he's going to, give you the entire history. And so, in fact, by the end, you can actually get your own degree in encryption. So I'd rather Nolan answer that question.
And just real quick, the second part, as far as the correlation of the rally in Bitcoin with the new addresses, I've read something, and I don't know if it's correct, that about 1% of the addresses own over 90% of Bitcoin. Is that true, and is that a concern?
I think it's a bit of a misconception because exchanges are aggregating addresses. So Coinbase is just might actually only, I don't really know, Coinbase could just be one address. But actually, if you're worried about concentration of supply or, hidden whales, remember, the stock market's got a bigger insider ownership problem. I mean, I'll give you an example. Does anybody here work at JP Morgan? Okay, so I worked there many years. This is a true statistic. What percent would you guess JP Morgan stock is held by current or former employees? Remember, it's a gigantic bank, right? It's like a couple $100 billion or $200 billion market cap. But what? So let me ask you to raise your hands. How many think it's 10%? Okay. How many think it's 20? Okay. How many think it's 40? It's close to 60%, folks. It's a lot. JP Morgan, pays its employees in stock. So anyway, so there's a lot, basically, but in Bitcoin, what's interesting is there's actually a lot of lost tokens. Because remember, if someone dies, if they lose, they throw away the hard drive, those tokens are lost. I don't remember the number. I'm pretty sure close to 10% of Bitcoin is lost forever because it's been thrown away. I mean, you guys just, just buy some stuff on eBay, like old hard drives, you might find Bitcoin on it. Or NSA secrets.
Last question over here.
I have a question regarding valuation of intangible assets. So I think you made a really good point in your presentation talking about how a large amount of the value of the stock market is intangible assets these days. So I was wondering if you were aware of any quantitative valuation methods for cryptocurrencies, because I know a main one you could use right now is kind of looking at the network effects, so the square of the number of users.
Mm-hmm.
And another one that is often used is the price compared to the number of nodes, number of addresses. So that's a common one to find like undervalued coins. So I was wondering if you're aware of any other quantitative methods to value these intangible assets.
Yeah. Well, I am aware of a professor who's writing a white paper on this. He presented this at Stanford in December, and he found that with some AI and some training, that if you go through a whole series of analysis, including the number for the core developers, the number of LinkedIn contacts they have, and then certain firms they worked at, plus the certain appearance of words in the white paper, okay? And I think it was the engagement level in social media. Anyways, he had close to 30 or 40 variables, and I think his first cut was like 400 tokens, but I think he says he expanded to 700. He found he could find with 80% efficacy the successful tokens. So when he publishes it, I told him I need him to be on my conference call, the first person on my conference call, but I think people are going to figure it out. But it's, right now it's early days.
Fantastic. That's a wrap. Thank you so much,
Great,
Thomas.
thanks.